Hello, learners. Welcome to another important topic in the working capital management, financing current assets. Financing current assets refers to arranging funds to support short term assets needed for operational activity. Current assets are short term in nature. The financing sources must be matched in terms of duration, flexibility, and cost efficiency. The objective of financing current assets is to maintain liquidity, minimizing the financing costs, and maximizing profitability. If you observe the different types of the working capital financing, which can be categorized into various sources. Say, for example, spontaneous sources. These sources are naturally in the course of the business operations itself. Say, for example, trade credit from the suppliers, accrued expenses like wages, utilities, and if any other deferred income. These spontaneous sources, they don't have any explicit interest cost, and they are flexible and self-adjusting with the business volume. Another important type is the short-term financing. So here in this case, the sources of the funds with the repayment where less than 1 year will be there. For example, we can take like bank overdraft and cash credit or short-term loans using commercial papers, trade credit. The importance of the short-term financing is that quickly we can access this finance. And when compared to long-term financing, short-term financing is available at a lower cost and flexibility will be there. Sometimes the short-term financing may affect the credit worthiness. Suppose if more and more times if we go for the short-term financing. Long-term financing, where we used to finance most of the times permanent working capital. Say, for example, using the term loans, equity capital, debentures, bonds, or through the retained earnings. One of the major advantage of the long-term financing is financial stability. And also the firm can reduce the liquidity risk. But there exist certain limitations also for long-term financing, because the long-term financing is available at a higher cost and having a limitation like less flexibility. So when it comes to the approaches to financing current assets. So what kind of strategy that we can go for financing the current assets? One of the popular is hedging or matching approach. So here what we are doing, we are matching the maturity of assets as well as liability. Short-term assets are financed with the short-term funds and long-term assets are financed with the long-term funds. Example, say for example, inventory, if we want to sell that inventory in 90 days, which is financed by a 90 days bank loan. The biggest advantage for this particular matching approach is reduced interest burden. So alignment of the cash inflows and outflows will be there. But there is a disadvantage with this approach. We are exposing ourselves to refinancing risk. Refinancing risk, suppose if short-term funding is not renewed. We have another approach called as conservative approach. We use this approach when we want to use the long-term funds for both fixed and a part of current assets. So in this approach, the emphasis is on safety and liquidity. Even if we observe the seasonal working capital, which is partially financed by the long-term debt. So the biggest advantage for this approach is low risk of liquidity shortage and stable financing we can observe. There exists disadvantage for this approach also. The major disadvantage is the financing cost. Financing cost is one of the major disadvantage for this conservative approach. Aggressive approach, financing even a portion of permanent current assets with short-term funds, which focuses on cost efficiency and profitability. Again, the biggest disadvantage for this one will be low interest cost. Disadvantage, high risk of liquidity crisis. There are certain factors which is influencing the financing decision of current assets. As already we have discussed certain factors in the working capital, factors influencing working capital. Say for example, nature of the business. Seasonal versus stable business require different financing strategies. Even in terms of business cycle, at the time of the expansion, short-term financing needs more and more. Cost of capital when choosing the source with a lower effective cost. And credit terms, especially in terms of the credit term, easy supplier credit can reduce the need for external financing. And market conditions, interest rate fluctuations impact the choice of long-term versus short-term funds. So with this, if we observe in a gist, the sources of finances, so which is represented in the form of a metric. So it depends on the financial manager what kind of risk he is taking and what kind of source he is adopting for raising the finance, especially financing from the current assets. Thank you.